So we're recording. So welcome everyone to Tom Williams' weekly session. Yeah, Friday 5:30 p.m. UK time. Tom's asking, are there any newcomers in the room, new to VSA or relatively new? Just type in something into the questions box just to give Tom an idea of his audience. Anything?
1,
2, 3.
No, 2.
Oh, very old.
There are about 3 or 4.
Yeah. Okay. So there's 3. Fine. Good. Okay. Tom, you ready? Right. Handing over to Tom.
Right. Thank you, Peter. Yeah, Tom Williams here, speaking to you from Worthing, Sussex, England. I've got a chart up here of the S&P 500, hour chart, right? And we can see that it's Friday, and they love to mark it up if they can on a Friday. The idea, of course, being that would generate good news for the newspapers and TV over the weekend, and then that means that the reports will be good. People will probably rush in and start buying, hopefully, and then hopefully they can sell into the buying. So you cannot believe anything. That's the reason why you can't really believe the television news, what you read in newspapers, what your broker tells you. You can't believe anything like that at all. The truth lies in the balance of supply and demand. Now, I believe there are 3 or 4 newcomers with us, and just in case they're not too quite familiar with what we look at, we're looking at the balance of supply and demand. Now, as you know, everything in the world more or less works on the balance of supply and demand within that area. But in normal behavior, the way that it's handled is that it's diluted, and it's not all that easy to see the balance of supply and demand. However, we're very lucky in the stock market because we can see them coming in there, or you've got to look on the professional money, or the smart money as Gavin calls them. These are traders that can throw in 50,000 contracts into the arena and also follow other professionals. In other words, what they've done, they've bullied their way into the market, which normally you can't see. When they bully their way in with these huge amounts of contracts, then they're altering the balance of supply and demand at that moment. And that's more or less what we're looking at, because it's no question about it. It's if there's more supply than there is demand, it's going to fall. If there's more demand than supply, it's going to go up. And what we look for now, the modern way we're looking at it, is what we call setups. And we're well into that. We've got a gentleman here from Russia called Mr. Gregory, and there's a specific reason why he's here. He's one of these Russian geniuses that programs, right? I mean, over the years, I've had about 8 programmers, as I've probably told you before, and not one of them know what the hell he's talking about. So it's not easy to program these sort of programs, not without a hell of a lot of effort and years of work. But there are individuals come along every now and again that do understand. And we're hoping that Gregory is one of these, which we think he is. But the market, without question, moves on supply and demand. And we could see one of the most popular setups, we call it, well, there are several, where you see there's been a down move, right? The down move in its own right creates a vulnerability to create interest within the professional money. They look at it and say, oh, it's come down 3 or 4 fairly decent wide bars. I think we can move in there, make a bit of money, and let it go up a bit. And that's more or less what they do. But when they do that, we see them coming in to what we call stopping volume. And that's always on a red down bar after a decline. And a signal should automatically appear telling you that it's stopping volume. Now on this hour chart here, now I don't know what this signal tells you.
Is this on the up bars? Coming
in? Yeah. No, this one. It's a down bar.
Yeah,
oh, aren't I on there? Ah, sorry, I can't see very well, and Peter's just rectified it. There is these are automatic signals that tell you the best we can from an automatic way without telling you directly what's going on. And these dialog boxes are very good, and there's a lot of information there in these boxes. And if you can move it to, sorry. So there's a lot of information in there, look. And that relates or telling you what's going on here. And here it's basically telling you professional money has moved into the market on that bar. Now, how do we know that? Because it's a widespread down, it's close to the middle, volume is increased, look, but it's well below this area here. And that's why we call it a shakeout. And the reason is, of course, some circles, they may even say that's what they call a springboard. But whenever you get a market going sideways like this, there are hundreds of thousands of traders that have traded within that area there. Some are long, some are short, some are sitting there watching it, some are making money, some are losing, it goes on and on. Now, professional money, part of their skill is knowing what will happen when they do certain things, right? That's part of your skill as a professional. And they know if they ram that market down like this, many, many traders in this area will start to panic. And they are liable to sell, dump their holdings, terrified of lower prices, right? So professional money say that's fine. We'll have that. And that's what causes close in the middle and usually increase in volume. So they're actually buying here. That's why we call it a shakeout. But you'll soon pick all this up. You'll soon see it all. And it's reliable because that won't change. That's there. It's a shakeout. They're buying. So on that buying, when the market turns around, it starts to go up. Right? And then this widespread up here bar, again, the reason why it's there is you need to understand human behavior, what's going on. All those traders that were in here that haven't been shaken out, right, are still sitting in there. Probably a lot of them are fearful. Say, oh, I'm not very happy here. What I'll do, I'll sell as soon as that price comes back up, if it comes up. Now, if you're a professional trader, you know this. So the best way to prevent these people selling is to ram it up as fast as you can, so that suddenly they turn the computer on, look and say, oh my God, look, I'm making some money. Oh, I'm staying in here, I'm not selling now. And that's all they don't want to have to buy what appear to them expensive holdings from these people here. They've shaken as many as they can out, caught load of stops, etc., etc. And that's why these widespreads are there. Now, there's a signal on that. What does that say? Supply. Well, fair enough, but we know it could possibly be absorption volume. Now, what we wait, this is the S&P 500, what we're waiting for now for confirmation that, in fact, that is what's happening. excuse me, we're looking for a test. Now, a test is very, very important move in the stock market, because whenever you see a down bar, right, it'd be a red down bar. I mean, there's usually loads of them, something like that or that, right? There's many things. They fall, the spread is fairly narrow, the volume is low. That means that the professional money are not interested in the downside. And that gives them confidence then to pour more money in and market up. That's what we're looking for at the moment. Now, the newsletter, the week before last, we added quite a bit of text on describing exactly what pushing up through supply to the left was, because there was a few people out there that weren't quite sure what we were talking about. But it's an understanding of what human behavior behaves when certain things happen in the stock market. If you're a professional money, you know what's going to happen. If you're a fire chief, I described it, you know what happens if somebody in a packed cinema shouts fire or bomb or something. You know, because you're a fire chief, what to expect. Professionals are the same way. It may be slightly confusing at first, but that's all it is. It's supply and demand generated by professional money that think nothing of 50,000 contracts. In other words, they're bully boys. They move in and force their way into the market, and it's that buying or selling that creates the imbalance of supply and demand. And we can see them doing it in most cases. And the more experience you get, the more you'll see. And then you could trade that. And once you get the hang of that, you'll have that information and skill with you for the rest of your life. And I can reassure you that you'll never, ever forget it or regret doing that. Never. Now, I've got Rita here and Peter. Have you traded this week, Rita? See, the trouble is, Rita's such a good typist. She gets bombarded with solicitors wanting her to work for them. Right? Eh? Lawyers, solicitors, whatever you call them. But they are. But given, and then she goes out and works for them and wonders why she can't trade. But please send your questions in, and I will do my best. And I've got Gregory here, who's a top-line programmer, who I'm sure can answer it perhaps. But if you've got any questions at all, please type them in. And Peter here, he's very good too. Reese says there are some.
Yeah, just to correct that, I don't want to work full-time. I like to work in the mornings and then trade in the afternoons. But I took something on recently, shouldn't have done it, and I'm working like mad anyway, and it's very stressful. So it makes me realise trading is the answer. Anyway, yeah, there's a question from Edmund, and it's something actually I can relate to because I would have the same question myself. That black bar there, Tom. Yeah. Is that a test or a no demand?
It's nothing. It's nothing. Why is it nothing? Whenever the price closes at the same level as the previous bar, it turns the bar black because it really hasn't gone up, hasn't gone down. It may have popped up and down within the bar, but it closes exactly where it started from. And to identify that, it's black. It comes into its own when you're following the trading system. It's what we call the simple trading system. The simple trading system is to understand that if you're a professional operator and you've got 100,000 contracts going there, right, you don't want to lose control of the move. and therefore you ensure that the close of the bar is always higher than the close of the previous bar. And we know that, therefore it turns it blue, look. However, if it is level, see the rule to follow the simple trading system is expect each bar to be blue if it goes up. Ignore the level bars, that's why it's black, because it would be a level bar. You allow for one down bar, which is usually a test of some sort on low volume. And that keeps you in the trade. No end of times. I have people say to me, oh, wow, yeah, oh, it's all right. I got in the low, but I sold out too soon. Matter of fact, somebody said that to me this morning. I sold out too soon. And that was the idea of trying to get the trending system right. And when you see those blue bars, it means that the professional money behind that move, I mean, it doesn't go up there on its own. It's pushed up there by professionals, right? And to ensure there's no friends in the stock market, remember. They all hate each other's guts. And if they can possibly benefit from somebody else's trade, they will. However, that's why they make sure that the close is higher than the close of the previous bar. And it's still going up at the moment, look. Does that all make sense?
Okay, hello. Julia says, please have Tom compare this chart with the SPY 60-minute. Tom only has the daily chart of that. So if you want him to look at that, just let us know. There's a question here, Tom, from Jerry. Are you listening? When you have a large down move with high volume and then the price bar eventually comes back to that level at a lower volume, how do you determine whether it will start to slowly move up for a possible long position or simply go sideways for an extended time, precluding a long position at this time? Do you wait for a shakeout before even considering a long position? I realise this is a very general question. An example of this can be found on the 240-hour euro dollar. We got that, Pete? Do you want to put that up? Did you get that question, Tom? Well, somebody's phone was going off, right? Yeah, 240 hour. Yeah, sorry, it's somebody's phone was going off. Yeah, here we go again, Tom. When you have a lot, this is, yeah, so when you have a large down move with high volume and then the price bar eventually comes back to that level at a lower volume, so it has done. Can you see it? Right. How do you determine whether it will start to slowly move up for a possible long position or simply go sideways for an extended time, precluding a long position at this time? Do you wait for a shakeout before even considering a long position?
Well, I can see what you're looking at. I'm looking at it now. But the thing is, I can tell you in a few seconds, that's weakness. So I'm not looking for a shakeout. I'm not looking for strength. That's weak, that market. Now, why can I say that? Well, first of all, you've got weakness in the background. Up here, look. That's weakness here. There's even a signal up there. What's it say? Supply. As I tell Gavin, you ignore the signals at your peril. Right? So it moves sideways. There'll be no demand in there, and then bang. Now, this widespread down like this is its weakness. It's a form of shakeout. The volume's high, admittedly, and admittedly there's an arrow on it. That's only because the computer's seeing the high volume closing in the middle. But what with the weakness in the background, and you see there is such a thing in the market, it's called vulnerability. If you're a professional trader, you'll see, well, definitely I can buy things lower prices here. But is that enough to entice you, or the risk of your 50,000 contracts is a risk to you? So you want to see the market fall lower You want to see at least one or two of these down legs before you become interested. We call that the vulnerability of the market. Okay, the whole thing is a bit chaotic, the market anyway. It's gone sideways, look. A little test there, no demand, never went anywhere. Another down bar with a red arrow, look. Trap up move, right. That whole market to me looks weak, and I would not be interested considering a buy on that right now. You need to see a definite, what we call setups.
Could you put up 6B cable 15-minute chart? Okay. In a moment. Bruce was the first with his question, so here it is. Could you look at cable 6B 15-minute chart for the 5th of November, Peter? So we need to go back to the 5th of November between 9 and 2, 9 a.m., 2 o'clock GMT. There was an end of the rising market signal, but the pound refused to fall. Why? So 0900 and 1400. Right, 0900, 1400. Right, so where's the end of a rising market? But what's that? We've got, oh yeah, look, there's an end of, says end of the rising market, Tom. So he's asking, there was that signal there, but the pound refused to fall. Why?
Well, at the end of a rising market, the computers looked at that and said, right, we've got an up move behind us. We're up here on a narrow spread. Okay, I've closed in the middle. In this case, the volume is low. This is the end of a rising market. I'd say that's what you told me 10 years ago in my coded lines here. So there it is. Now, it's correct because, look, the market just went sideways on that. It hasn't gone down, but it has gone down, but it hasn't gone up. That's the main thing. That signal is correct. Now, just trying to move. Never seen the move go there. So end of a rising market there, and then the market fell. You ignore the signals at your peril. Now, sometimes these charts are slightly confusing because the way the computer works, it resizes the chart to fit the screen, as you can see. So that's why I like to look at an hourly chart or even a daily chart, where you get a better picture of actually what happened. But when you see end of a rising market, believe it, believe me. Don't argue with the computer. I can tell you that many times.
Still on the pound, the daily chart this time, Peter. Carlos says, hi Tom, please check the pound daily chart and tell me if it looks bearish to you.
Well, I think Gavin went short on this earlier on, made quite a bit of money, I think. And I think Gregory here did, but he got out now. He was just before we started, so I'm looking for a short on the pound. He's still looking. Now, the thing is that you've got weakness here. Look, it's pretty obvious that's distribution up there, look. That's weakness without any question. All right. The market fell. Now, you get in the market often what they call an automatic rally after a fall. And that's why we use the 50% retracement. It usually goes up 50%. It's almost like holding a tennis ball in your hand and dropping it. And you know the fact it's dropping it, it's going to rebounce. But it won't bounce back up to your hand. It'll probably go up at least 50% of the fall. Fibonacci. That's the only mathematical thing I've ever looked at in my life. And it does seem to work, but I don't trade on it. It's just an observation. But what Gregory said to me, well, what I'm looking for now is a clear upthrust or no demand here. But it looks as if we've missed the boat here because it's fallen. We were talking when it was around about here. So that's weak.
Okay. Right, Carlos is saying yesterday's bar on the pound looks like a shakeout though. That bar, yeah. Yesterday. No, the one before. He says it looks like a shakeout. Can you comment, Tom?
Well, the idea of a shakeout is put the fear of God in you, to shake you out of any holdings you have. And surely it's a bit high, isn't it? It almost looked like an attempt to test the market, not shake you out. A shakeout will occur if they're going to do it somewhere around here. Where, Gregory? Right. It'll rapidly fall, might even close on the low or close, but that's a shakeout then. But you don't get shakeouts up here. It's not dramatic enough. That's almost like a test or start of a test. Test that miserably failed, look. That's not a shakeout. You've got to put these principles like shakeouts that in the right area. You know, the different charts and different moves may look slightly different and create even different indicators. But you've got to understand underlying what's going on. A shakeout is a shakeout. It doesn't really look like a shakeout, does it? Where's the fear going to be there? A shakeout is something dramatic, where it dramatically falls and then closes on the high on some sort of bad news. It's pretty obvious. It should produce a signal as well.
So, folks, this is the hour of the same chart.
That one, what about that?
Yeah, Tom.
And what are we looking at?
This is the pound 1 hour.
Well, yes, you see, here's a dramatic down bar. Basically, it's a weak bar. Why? Because it's got what we call a top tail, look. Whenever you see the bar high up like this, and it closes down, we call that a top tail. Normally, a strong stock doesn't do that, or currency. It doesn't do that normally. So you proceed with great caution here. But this is down. This is more like a buy bar here. This one, this red one here. It's down. It's a narrow spread. And the volume is low. Now that could definitely or possibly bring a small move up. But it's not going all that far because there's nothing dramatic enough here to say, right, I'm going to shoot back up to heaven here. Basically, that looks weak, but you would or could expect an up move today, Friday.
Oh, hang on.
All right.
Do apologise, Carlos. We were looking at yesterday's action, so please look at the hourly yesterday action on the pound, please. Correct. We were. Yesterday. So can you go back to yesterday, Peter? Yes. Correct. Yeah. Is that the area, Carlos, that you're... I'm not sure, he's not responded, so...
Well, this is the hourly chart of the pound yesterday. And I think I was watching this. I look at so many charts I tend to forget. But here's the red down bars, look. And there is some dramatic volume appeared. And there's two down bars, red down bars. And what's that thing? Yeah, now it's the computer tells you, just what I've told you, professional money, if they think they can move it up a bit, they will step into the market. And that's, they leave what they call their footprint. They got a job to hide it because of the size of their contracts. So they move into the market. You see this very high volume and high activity. And on that, the market turns blue and starts trending upward. So they were definitely buying there. It didn't go all that far, but they were buying there. But sometimes they're only after a move up to here. Some warning signals here, look. There's an up thrust along here, look. Okay.
Lezek says, Tom, there was a sign of weakness on the 18th of September communicated via Trade the Market signals, and a week ago, during closing bell, Gavin was bearish. Recent uphill is the result of a good news on Tuesday morning, which was probably a surprise for many, he says. Do you want to put the daily chart up? Have we looked at that, or am I... Oh, we have, I see. 18th. Right, so there, yeah, sign of weakness, and Gavin was bearish, and the recent uphill is a result of good news on Tuesday morning, which was probably a surprise for many. Me too, he says. Oh no, he's saying 18th of September, sorry. Put up loads of bars so we're not... '18th there. Kind of, yeah. Okay. Comment on the euro, please, says C. Long. I don't know what time frame you want, but should we put the daily chart, the euro, up? And if anybody else has a chart they want us to look at, please put it into the questions box. This is the daily of the euro, Tom.
So this is a daily chart of the euro. It's been acting a bit odd for some time. Okay, so you've got a wide spread up here. Right. Now the thing is, you see, you've got this red arrow. Yeah, which is probably correct. But immediately the next bar, we've got the test. That is a test, look. Test. Now that means that they've tested that supply professional money have seen that, right? They want to make sure that their 50 or 100,000 contracts are safe at the moment. So they test it quickly. It's given a positive result, and so they mark it up as fast as they can, right? But then it starts rolling over, look. When you get these mushroom-type tops and weakness in the background, that's usually not a good sign, right? I'm only looking at this chart, but I'm sure if I studied other charts, you'd see other sorts of weakness. This euro's having a hard time recently.
Yep. Anne would like us to look at V and give your thoughts, Tom, on this daily chart. V. Is that Verizon? I mean, you could put the end of day up, Peter, but no. All right. Visa, says Thomas. This is Visa.
Well, okay, it's not a bad-looking stock. But the thing is, that it's not acting strong with the index, so it wouldn't be on my watch list, and I'm sure I haven't sent it out to be on your watch list. And there is weakness up here, look, there it is. We don't like weakness in the background. Even that bar looks weak, right? There is a test here. Whenever you see these tests, you expect immediate high prices. And they've even gapped it up by the look of it. Bang, bang, up it goes. But that market looks fine up to then. And then it falls like this on quite high volume, look. They came back and bought some, admittedly. But a strong stock wouldn't do that. A strong stock stays up here in harmony with the general index. This is quite a good stock. It's not the sort of stock I put on your watch list because of weakness or trade in the background.
Okay, there aren't any more questions at present, so shall we go back to the ES, Peter? Have a look at what's going on now.
Yeah, let Gregory say a few words. I'll say a few words. Gregory. Now I've got Gregory sitting beside of me. He's apparently one of these Russian geniuses that with programming. So there's all sorts of stories how they materialized, of course, how they were doing the Cold War stuff and all that nonsense. But this is Gregory, and I'll let him say hello to you.
Hello everybody, Grigory's here, and good day, good evening, good afternoon, whenever you are. So one of the reasons why I'm here these days, we are working on the scanner, what many of you have already seen and been testing, and we also hope that this scanner will be improved as well. So that's all.
They are, so you can't say we're not trying. He's flown all the way from Moscow. It's surprising. It took 4 hours, he said. I didn't realize Moscow was that far away from us. He landed at Gatwick, so it was fairly easy for us to pick him up while Gavin went and picked him up. And, of course, he loves all this stuff. So we do too. Rita certainly does, and Peter does. They love all the intrigue and but if you stick with it, it took, I think, Rita 2 years, was it, Rita, to really understand what was going on.
Yeah.
And then she started trading successfully. Of course, you see, once you learn to read the chart, I mean, that's what I call the first hurdle. But then you have to overcome another hurdle, and that's your own emotions. And they say women are better traders than men, because men, they enjoy taking risks. They enjoy standing at the cave entrance with their spear, looking out, wondering. And if they were fearful, they would be fearful they couldn't go out and hunt. You'd all starve to death. So there's that built into mankind, which unfortunately is carried on in the modern day man to the stock market, where women aren't quite like that. They're far more logical, and they don't really like taking risks. And therefore they wait for the logic to appear. And I think Rita certainly falls into that. What? Or unnecessary risks. Peter just chirped in, which is true. So there's all these obstacles to overcome. But once you absorb that, and once you learn to read these charts, I can assure you, you'll never, ever regret it. It opens up a whole new world to you. Very few people in the world, I mean very, very few, understand what we're telling you. Very few. And that's the reason why I don't talk to anybody about the stock market like this unless they're on a seminar or they show interest. Just wasting your time. They look at, even the clever programmers don't. Gregory here does. But I've had 8 programmers here from universities and things. And they work for 8 months and then disappear. You still don't get anything because they haven't understood what you're talking about. And these are clever guys, university trained. That's what makes it a bit tricky.
Are there any more questions, Rita? No, we've run out of questions, so we're going to look at the 15-minute chart of the S&P future. And what do you say, Tom?
Well, what I'd say is it's been looking weak. It's been okay. Now, funny enough, it's so common these days. You get these red arrows, look. Is that cursor moving? That one. Sorry. Oh well. Now what's interesting is this seems to happen very, very often. You get these red arrows suddenly appearing like this, right? Which if you're not trained, you may look at that and say, oh well, that program's not much good, look. It's giving you red arrows here, look. Matter of fact, there's 2 there. Yeah, same, right. However, if the volume is low, there's no test there, is there? I can't get this cursor to work. There it goes. Go. Sorry, folks. Right, but that's a down bar, look. That red one. And look, the volume is fairly low. And the bars are blue, shoot into the trending system, look. But you're going up. There's a red arrow there. There's definitely weakness there. And notice it's rolling over slightly, like the top of a mushroom. That's normally, distribution does that. Slow distribution. They hold a market up on every automatic wave, up wave, right? They sell some to you, and then they support the market so they can sell more to you on the next wave up. And that results in a mushroom shape at the top after you've seen that move. That's normally a sign of weakness. I certainly wouldn't be interested in going long at the moment. You don't go long or you don't go short unless you see what we call a setup. And we hope, give us time, we'll have these automatic setups very, very accurate for you.
Anybody got any questions? Now's your chance. Just type it into the questions box. Questions about a chart or a principle would be good. And there's no daft question. Okay. I'll hand you over to Rita.
We need to go back to... Chris, is this about the last chart we were looking at? Yes, yes. What were we on before? 15-minute. Tom, can you decipher this action around 2:30? We attack the top of a large down bar, the shakeout, on high volume, promising that we take it out, and then a setback, a down bar. Peter, take it. Yeah, keep going back. Oh, that's it. Right here, he says. The 2:30 bar. You need more bars, says Chris. We'll put a few more. The thing is, you see, because of Tom's eyesight, we can't put up lots of bars. But so when he's talking about it, yep, was it that one? Yes. Can you decipher this action around 2:30? We attack the top of the large down bar, the shakeout, on high volume, promising that we take it out, and then a setback, a down bar. So, Tom.
So the interest was we had this down move here, yeah, and then we had a move up towards the top, and then perhaps against all expectations, it popped down again before it went up. Could you talk about that?
Well, the thing is, when I look at a chart like that, immediately I look at the background. I can't help looking at this. And immediately you could see the stopping volume there. Now, maybe not be a signal on it because it hasn't fallen down enough. But you could see it's a sharp move down. And you could see that there's a huge increase in volume. Right, so we know they must have stepped in and bought there, especially when the market responds up like this. Okay, so here we have a test. Right, the first red down bar after that. Now, admittedly, there's a red arrow on it, supply, but look at that low volume. That signal is not correct. A signal should not come in. Well, it might be, well, you're talking to your computer here, but whenever you see a red down bar and the volume is low like that, look, relative to the previous volume, which is high, look, supply must have disappeared. And if there's no supply, then it means that demand must be greater than the supply, and that will allow it to go up. It's as simple as that. And that's what's happened here. So you've got an up bar, again, with a bit of high volume. Down bar, the volume is fairly low, but it's less than the previous bar. It's turned around, blue bars. So they probably, professionals, are a bit confused themselves around here. Don't forget, they don't always get it 100% correct. And that's why it's arcing over like that.
Chris says, thank you, Tom, for that. Enrique says, I have Infinity AT and the signals do not match with the one on your chart. Do you know why? Maybe the clock or the time is different, just if you know of others having the same problem. Do you want to speak? Go on. Yep. All right, pick my husband.
I think probably the best explanation we have is that, of course, in each chart package, they are different programs, and there may be slight variations on the data as well. So that's why you may get discrepancies. Sometimes there could just be errors. Tom, maybe you've got an answer to that one.
On what charts are they different? Well, first of all, I've never seen a plugin personally. Gavin in his wisdom got these Hollywood guys who are supposed to be clever programmers to do these things. I've never once seen a chart. I've never once been asked to check them. Never. Not one of them. But I could check my charts, which I did here. And there is a very fine line here between bringing up a signal or not a signal. Like Gregory here, the programmer, said, look, you've got 6 end of rising market signals. I said, well, the reason why there's 6, they're all in a queue, and the parameters on each one could be slightly different. It's best to have one come up somewhere than none at all at the end of a rising market. In other words, the volume may be different, or maybe low volume, like we saw in that last one, and so on and so on. And that's the reason I've never been asked to check other programs at all. And that's the reason. But the principle should be there readable. You still should be able to understand and read the chart.
Yeah, so in my own experience, when I first started looking at this, I, as probably advised by everyone else, is to use the chart package with the indicators as a learning tool, a teaching tool. And the reason for that is quite simply is that if you were to rely on an indicator and just follow that, you may well be okay. However, you need to understand what you're doing. You need to understand why the indicator comes up, because it's telling you something. And so don't slavishly follow what the indicators say, as in reacting and putting an order in the market. Merely use them as to a teaching aid. So why did that indicator come up? Read the dialog box. And then you are the trader, of course. So currently you are the trader, and it's your job to understand what you're seeing, and the charts there with the indicators are an aid to that. Rita's PC just crashed, so we lost your questions for a moment. Are you back, Rita?
Yeah. Jerry says, Tom, I'm at my 2nd year of studying VSA, and what I find challenging while using your example of when the Prussians came in to assist Wellington at Waterloo, are they strong enough to change the time? This is the challenge when the next bully comes in, whether they have the power to change the direction for a possible trade. Do you get that, Tom?
Oh, yeah. But the whole thing is, they probably know whether they're strong enough or not. And they're probably not going to risk their money unless they're pretty certain that they are powerful enough to alter the trend of the market. I mean, that's quite a good example, wasn't it? Waterloo, there's Wellington there. He's been scrapping away with Napoleon all day, and they're waiting for the so-called Prussian army to show up. And when it appears up over hill, then that alters the balance of supply and demand. There's far more power has entered Wellington's side and that helps him to win the day, apparently. But if you're a professional, you will know whether your power is sufficient to create a trend or turn the trend. If you look at these charts carefully and watch the stopping volume, I think you'll find that you can see it, and it's there. And once you learn to recognize it, it'll appear time after time, probably for the rest of your life. You'll see that coming and going like that, and you know exactly what's happening, and you could definitely make some money on it. I mean, we made some, Gavin made some money yesterday or the day before on one of these charts. I think it was the pound or something. It came down. You saw the stopping volume come in. You saw them entering the market. It arced over about a few bars, right? And it fell back down into that level. It's a level that's important. And when it falls back down to that level where you first saw the stopping volume, and the volume was very low, it's telling you loud and clear that there was supply at that level previously is now disappeared. And because the market moves on supply and demand, if there's no supply, it must mean demand is greater than the supply. And it went up. These are things you need to look for. It may be slightly daunting if you just come in and say out of the cold. You come in from all your technical analysis. I mean, I was just talking to my Russian friend here about technical analysis, for example. I would not expect normal technical analysis to work, like even moving averages or stochastics and all that stuff, because there's so many clever people out there, and I mean clever. Not only are they clever, they're back with money. Now, don't worry, all these years, if there was a formula there that was guaranteed to make money, they would be onto it like a shot, believe me, same as you would. And as the mathematical formula formed, right, they would be in on it to such an extent it would dilute what you're looking at, and it wouldn't work, wouldn't be there. And that's why, in my opinion, it may look all right in hindsight. It looks all right in hindsight because nobody traded it, or there wasn't sufficient people there to trade it. And I think you'll find I'm right.
Okay, so one final question. This is from Louis. This relates to what we were talking earlier about, or I was talking about the software and the indicators and all the rest of it. Louis says, the problem is we are learning, and if your software gives wrong signals, how can you learn?
Well, actually, most of the signals are never wrong, because I could show you in hindsight, as things move, why they're not wrong. Because it's, you know, there's such a thing as chart as point figure, which they use, come in useful for. There's all sorts of things. Unless you're familiar with all these other things that a chart can do, then you may look at a signal like there's such a thing as preliminary stopping volume, or preliminary support, or preliminary supply. Right? That works. You see red arrows appearing, and the market may still go up. But those red arrows mark where they first started distributing. And we can tell that in hindsight, because it usually arcs over. And if you've got a point figure chart, you can take a count right across there. So, but the whole thing is with the signals, is to try to train you up to recognize what strength looks like and weakness looks like. Okay, and not listen to the news, be influenced by the news, or the newspapers, or your broker, or anybody else.
Louis saying, Tom, the problem is that sometimes the signals don't appear or are wrong on the MT4. Do you want to say something to that, Tom? MT4, it's another platform. But my personal opinion, for what it's worth, is that to protect ourselves, and something I've done, is I actually learnt from myself. So yes, you can use the program to learn, you can use the dialog boxes, but I actually read the charts based on what I know about VSA, about volume spread and analysis, and I use the signals within the software as confirmation or some kind of a reassurance or to raise questions. So it's kind of a personal responsibility thing, I suppose. That's for me. So does anybody else have anything to say? Tom, Peter? Yeah.
I think that's it, folks. So, Tom, got any final words? Oh, we've got the newsletter coming up. Oh, Tom's put his hand out. Hang on.
Well, I must say, with these other platforms, I've never seen one. I've never, ever been shown a platform that you're talking about. So I don't know whether signals are any good or not. It's certainly not my work. And that's all I can say. But Gavin, in his skill as a salesman or whatever, you have to ask him. Hey. I would ask him tonight. He's on.
He's on tonight. Okay. So we'll do the newsletter on Sunday.
We do the newsletter Sunday, and keep my fingers crossed. Hope I get it spot on for you. I'm the only one out there that sticks his neck out saying it's either going up or down, apart from Gavin, who's standing right beside of me. So I say goodbye.
Yeah, so half an hour, Gavin will be on with his last bell, closing bell, final bell, yeah. So tune in about half an hour, just before half an hour. Yeah, Gavin's saying NASDAQ's a big one. So with that, we'll say goodbye from Tom, Grigory, Rita, Peter, Gavin, Dallas, and the rest of the crew. And we'll see you all next week. So have a good weekend and cheerio.